So the other day, I had a client who needed to move. They wanted to be closer to their grandkids. The only way to afford that move was they needed to pull $100,000 out of their traditional IRA. Well, as you probably know, anytime you pull money out of your traditional IRA, you have to pay taxes on it. Now, they could afford to do this, so it wasn't a problem in that way. But it was a problem in that when they pulled that $100,000 out, it kicked them into a higher tax bracket. And the only source they had to pay for those taxes was the traditional IRA itself, which meant they had to pull even more out to pay the taxes and pay taxes on the taxes. You can see how this can spiral and cause a lot more in taxes than you would hope for. A situation like this, it'd be really, really nice to have a Roth IRA. Any money in a Roth IRA is tax-free for life. But the problem is, if you actually make a good enough income where you're maximizing your 401k and you're maximizing your HSA, you probably make too much money to actually put anything into a Roth IRA. They limit income to about $280,000. So even if you're doing everything right and you try to contribute to your Roth IRA, the IRS will say no. You're of course not happy about this because you know that Roth IRA money grows tax-free. And you know it could save you tens or hundreds of thousands in retirement. And so, of course, you feel like you're penalized for earning a good income. And it's true. But what you might not know about is there's actually a completely legal two-step process to get money into your Roth IRA, even if you make more than the limit. It's called a backdoor Roth IRA. And this is something I see clients miss all the time. And many of the times when I see clients doing this, they're actually not doing it right. My name is Bjorn Amundson. I'm a certified financial planner here at Quarry Hill Advisors, and we specialize in helping corporate executives and high-earning professionals navigate the complex financial decisions that come with significant wealth. So one of the biggest ways I see people mess up the backdoor Roth IRA is from something that we call the Pro Rata Rule. And it trips up quite a few people who attempt this strategy without understanding how it works. So in this video, I'm going to walk you through exactly how to execute a backdoor Roth IRA in 2026, step by step. And most importantly, I'm going to show you the single biggest mistake that turns a tax-free conversion into a taxable event. So in 2026, the rule is that you can contribute up to $7,500 to a Roth IRA if you're under 50, or $8,600 if you're 50 or over. But you can only do that if your income is below certain thresholds. So for single filers, that phase out starts at $153,000, and then you're completely ineligible above $168,000. For married couples filing jointly, it's higher. It's $242,000 and up to $252,000. So if you're a corporate executive or a high-earning professional, you're almost certainly going to be above these limits. But here's what happened in 2010. I remember the day when Congress removed the income limits on Roth conversions. What that means is there's no limit on how much you can take from your traditional IRA and put into your Roth IRA. Now, if you have taken a deduction for what's been in your traditional IRA, you do have to pay taxes on that, but once you pay the taxes and it goes into your Roth, it's tax-free forever. So when they did this, they sort of accidentally created a perfectly legal two-step loophole. So a backdoor Roth IRA isn't a different type of account. It's a strategy where you just use existing rules in a specific sequence. So first, what you're going to do is you're going to make a non-deductible contribution to a traditional IRA. There's no income limits for this because you're not taking a deduction. So it goes in there. There's no deduction. It's after-tax dollars. Step two, you convert this IRA into a Roth IRA. And since the IRS allows anyone to convert regardless of your income, you can do it. Since you've already paid taxes on this money and it's a non-deductible contribution, well, you get to convert this tax-free, so there's no earnings on it. So the result is that you've basically made a Roth IRA contribution even though your income is over the limit, and then that money can grow tax-free for decades. This is completely legal, and the IRS even clarified this in 2018 that they're fine with this strategy. They know about this strategy, and I see a lot of times in the budget when they're talking about doing different tax laws, they consider closing this loophole, and then they end up not doing it. But you have to do this right. You can screw this up and cost yourself thousands of dollars in taxes. So let's be careful about how we do it. So the first thing you're going to want to do is open up a traditional IRA if you don't have one already. It needs to be a traditional IRA at your brokerage firm. And if you don't have one, just go ahead and go get it open. Step 2 is you make your non-deductible contribution. Again, that's $7,500 for 2026 if you're under 50 or $8,600 if you're over. And make sure this is an after-tax contribution. You need to mark it clearly as non-deductible for your tax records. By the way, this is not shown to CPAs clearly, and it's really hard to do right in TurboTax, so you may want to have a professional look over your shoulder as you do that. Step 3 is you're going to just do nothing, and you're going to let the money sit there for a couple of days. Step 4 is you're going to convert it to a Roth IRA. You log into your brokerage account and convert from the traditional IRA into your Roth IRA. Every major brokerage is going to allow this feature. You should choose not to withhold any taxes since you're converting after-tax contributions. The IRS says there's no required waiting period, but I think most tax attorneys would recommend waiting a few days or even a week or two. The reason for this is that you want to avoid a thing called the step doctrine, which is something we're going to talk about later. Step 5, you're going to want to file a Form 8606. This is going to be something you file when you do your taxes, and it reports your non-deductible contributions and proves that you already paid taxes on the money. Without this, you could accidentally end up being taxed twice on the same money. So that's the process, 5 steps. Let's talk about some of the problems. This is pretty straightforward when your IRA situation is clean and it's the only IRA you have, but this is one of the areas that I see a lot of people run into trouble. Now, there's a thing called the Pro Rata trap, and I've seen it cost clients $2,000 or even more. The Pro Rata Rule says that the IRS doesn't let you pick or choose one specific IRA that you're converting from. So they treat all your traditional IRAs, SEP IRAs, and simple IRAs as one giant account. So even if you have an IRA that's empty at Schwab and another traditional IRA that has some money in it at Fidelity, they will look at both of those accounts and add up the balance for both of those to see how much of your IRA is pre-tax. So again, even if you have separate accounts, that still doesn't do it. You have to actually make sure your IRA balance is 0. So let's say you have $100,000 in a rollover IRA from your 401k. That's all pre-tax money. You then contribute $7,500 to your new traditional IRA, and it's a non-deductible contribution. Your total IRA picture now looks like this. You have an IRA with $100,000 pre-tax in it and a separate $7,500 after-tax IRA. So your total IRA dollars are $107,500. Now, when you convert the $7,500, even though you never mixed it with $100,000, the IRS is going to tax you based off of what percentage of your IRA was tax-free. In this case, 7,500 divided by 107,500 is 6.98%. So only 7% of your conversion, about $500, is tax-free. The other 93% is taxed at ordinary income. So that's going to defeat the whole purpose of your backdoor Roth IRA. And this happens when people have other IRA money and they forgot or didn't realize it counted. There are some cool ways where you can avoid this tax trap. So let's go back to the beginning. Let's say you're just like a hypothetical client. We'll call you Sarah, a Target senior director earning $195,000. She looks at her income and it's over $280,000, so she's well over the $252,000 limit, and she's maxing out her 401k and HSA, and she wants to save even more for retirement. Well, she has this problem, an $85,000 IRA from a previous employer. It's all pre-tax money. If she had contributed the $7,500 and tried to convert it without addressing that rollover, well, she's going to have about 8% of her IRA be taxable, and it's going to cost her around $2,000 in taxes. So instead, what she could do is roll that $85,000 IRA into her target 401k. So now, if you look at her traditional IRA balance, it's 0. The IRS doesn't count 401ks or 403bs towards this pro rata calculation. It's no longer an IRA. It no longer counts. So she never changed the tax status of her money. She just moved it to the 401k, and thus she can now do the backdoor Roth IRA all the time. And if her husband does the same thing, now they can be saving $15,000 per year into a Roth IRA annually. If you do that for over 20 years and get something like a 7% return, they would have over $615,000 in Roth assets. Now, one trap here is that a lot of financial advisors like to charge fees on traditional IRAs, and they can't charge fees on 401ks. So they may intentionally not mention that you could free up this option by moving the money to the 401k, because that would affect their fee. So if you have a financial advisor who isn't talking about this scenario with you, you should give us a call. So let's talk about 3 ways where you can avoid the pro rata trap. So in the example above, Sarah used the first approach, the one that I normally recommend. So solution 1 is you put your IRA into your current 401k and keep it all as pre-tax money. The second option, which works if you maybe don't have a 401k you can roll over into, or maybe you have a plan. Once in my career, I ran into a client whose plan wouldn't accept rollovers. Well, if the IRA balance isn't very large, it may be worth converting the whole IRA to your Roth. You'll pay taxes on the pre-tax portion, but then you could open up the back door forever. Solution number 3 is start fresh. And so just be planning ahead and don't roll old 401ks into IRAs if you think a backdoor Roth IRA might be an option. Keep them in your 401k or roll them to a new employer's plan. This keeps your IRA clean for backdoor conversions going forward. Let's talk a little bit about this step transaction doctrine. You've probably read, if you've done any Google searching or AI's research, about the step transaction doctrine. So this legal principle says that if you do multiple legal steps, all to accomplish something that would otherwise be prohibited, the IRS may treat this as one prohibited transaction. The reality is that the IRS clarified in 2018 that there's no required waiting period between contributions and conversions. So this strategy is legal and acceptable, and I haven't seen anyone who's gotten penalized for doing a backdoor Roth IRA. So we do recommend waiting a few days just to avoid the step doctrine, but we're probably being overly cautious here, and you should discuss this with your own planner or CPA. Okay, so some key tips to keep in mind. You can contribute your 2026 IRA contributions until April 15th of 2027, so the year after. But contribute earlier if you can, so the money has time to grow. If you're married, both spouses can do the backdoor Roth conversions, even if only one of the two of you has earned income. So that's $15,000 annually into the Roth accounts. Remember, the pro rata calculation is going to look at your IRA balance as of December 31st of the conversion year. So make sure you complete any IRA rollovers into your 401k before year end. So this is an annual strategy. Repeat this every year. Many of our clients have been doing this annually for as long as we've worked with them. Each conversion has a 5-year holding period. This isn't an issue if it's long-term retirement money, but if it's money that you unexpectedly need sooner than 5 years, it could be an issue. So remember that anything in there is going to be locked up for 5 years. You should check if your 401k allows after-tax contributions and in-service distributions. Occasionally, I'll find a 401k that does allow this. If you can do this and you have enough to save, you could be eligible for what's called the Mega Backdoor Roth IRA. So this could mean you save $25,000 or even $47,500 or more into Roth accounts annually. It's much more complex, but it's worth exploring if it's available. So let me come back to where we started. If you're a high income earner who's been told that you can't contribute to a Roth IRA, that's only half the story. The backdoor Roth IRA is a completely legal, IRS approved, and one of the most valuable strategies available to you. But you have to remember the Pro Rata Rule can turn your tax-free conversion into a taxable mess if you're not careful. So you need to understand the entire IRA picture before you start this. And if you have any questions about how this fits into your overall financial plan, or you're not sure how to properly execute this, we're here to help. Click on the link in my description and we'll give you a call and we can talk through the full retirement planning process. Thanks for watching, and we'll see you in the next video.